Happy Tuesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, April 30th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro events are fresh evidence of our green shoots globally and China front-loading stimulus themes versus the likely death of our Jay and Janet want a soft landing theme. So the nuance there is that the Q1 GDP data from the Eurozone economy was supportive of our green shoots globally theme. Elsewhere, the latest leading survey data from China and coincident activity data from Japan were supportive of global liquidity in that they signal the PBOC is unlikely to pull back on support of the Chinese economy, and the BOJ is unlikely to accelerate policy normalization. Elsewhere, the Q1 employment cost index out of the U.S. economy was highly supportive of our sticky inflation theme. So in terms of market implications, I recall that the ECI is the broadest measure of wages and benefits here in the U.S., and that the Fed strongly considers it when deliberating the outlook for monetary policy. With respect to fiscal policy, yesterday's quarterly refunding announcement was much more hawkish than we were expecting. Recall that our Jay and Janet want a soft landing theme was the lone key macro force preventing our sticky inflation and global liquidity retreat themes from becoming dominant drivers of asset markets. And the final couple sentences there are some very important quantitative risk management signals that are exclusive for our 42 macro clients that can help them make some changes, very important changes in their portfolio. So obviously that's embargoed for folks who support our business. So as always, we'll wrap it up, transitioning to our 42 macro dashboard here, wrapping up with the question from our community. This one reads, short to medium term signals from our positioning model. It says, hi, Darius, I'm a new member and quickly digesting the content. Please explain on the following blurb from the April 29th leadoff morning note. So the blurb reads, risk asset valuations are currently consistent with major bull market peaks. In totality, our positioning model indicates middling risk of a cross asset correction over the short term and elevated risk over the medium term, or elevated risk of a crash over the medium term. So the question reads, is it correct to assume that the bull market peak, if it occurs, is considered a cyclical peak? The answer to that is yes. And then regarding the elevated risk of the crash over medium term, comment, what is the range of a decline that defines a crash? And in our opinion, it's anything on the order or in excess of a 20%. We would consider a down 17% market a crash as well. That's obviously very much a crash relative to where we are in the positioning cycle. So whether or not we believe that is like the highest probability outcome, obviously we're not going to tell you that here for free. You need to be supporting our business to do that. So we'll wrap it up there. Darius Dale presenting our macro minute for Tuesday, April 30th, 2024. Everyone have a wonderful day. Best of luck out there. We'll catch you back here tomorrow. Cheers.